Now, in order to get a better idea of tax loss selling and exactly how this works and what it looks like, let me give you a couple of examples, and just really, really simple examples. That way you will understand what goes on here. So let's say back in January, somebody were to have bought a share of stock at $100, right? The cost of that share was $100. And let's say that stock went up in value by $10, and they're sitting today with a $10 gain, a 10% gain, since it's, you bought it at 100, you made a $10 gain, that's 10% gain. And let's say they sold that share of stock. Well, as we've talked about before, that would trigger short-term capital gains, which is nothing more than you having to pay when you file your taxes, income tax on the gain that you made. So in this case, it's just a $10 gain. And so let's say you're in the 25% federal tax bracket, then you would only have to pay $2.50 of the $10 gain. But you can see how that can be quite substantial eating into your gains in paying that short-term capital gain rate. Now, let's say somebody would have bought a share at $100 last January of 2019, and held it until today and then decided to sell it. Well, since they held it for more than a year, then that same $10 gain that they may have made, they could sell. That would still trigger a tax event, but that tax event would not be at the income tax rate. That tax event would be at the long-term capital gains rate, which for most people is 15%. Check those brackets, because I believe for a married couple making less than $80,000 or a single individual making less than $40,000, then you pay zero. And then there's kind of a little bit of a stair-step effect there on those capital gains rate, but most people are paying 15% on capital gains. And so you would see they would pay less. In this case, they would pay $1.50 of that $10 gain in capital gains tax when they filed their taxes. And so that would be their tax liability there. Now, let's say that somebody bought a stock, whether it be this year or last year, doesn't matter when you bought it. But let's say you bought a particular stock and it has decreased in value by $10. So now it's only worth 90 instead of 100. It's only selling for 90 currently. Well, then what you can do, and this is tax loss selling here, you can sell that share of stock and you have taken a $10 loss. Well, now what you can do is you can deduct that $10 loss from your taxable income from this year. Now, you may say, okay, on a $10 loss, that's not a really big thing. But let's say you had $100,000 worth of a stock and it went down 10%. And so now you're sitting with a $10,000 loss. Well, you see how that could substantially impact your taxable income for this year. And so you would want to take advantage of that tax loss selling. Now, a couple of caveats of this tax loss selling that you need to understand. One, you can only do this if you are to sell and then not take an identical or almost identical position within 30 days. Now, if you were to take that identical position within 30 days, then they would call that a wash sale. That's what it's called by the IRS, is a wash sale. And wash sales do not qualify for the tax deduction. And so you need to make sure that if you go ahead and sell, you have to know that you can't take that position back, if you want to take that position back, within 30 days, or else you will not qualify for that tax deduction. Now, in a similar way, we must also understand that this only occurs for taxable investments. Okay, so if you have an IRA in which you do buying and selling, or which you've just bought something and it has gone down in value, then you cannot get this tax deduction from that IRA, because the money in, let's say, a traditional IRA, as we know, is tax deferred, right? So you're deferring taxes, so that particular buying and selling within it is not going to trigger a tax event. And then with a Roth IRA, we know that there is tax-free growth. So still, we know that there is not going to be a taxable event because you would sell something at a loss within an IRA. Same goes for a 401k or any tax-advantaged account. This is only for a taxable investment account, a taxable brokerage account in which this takes place. Now, some people have these, some people don't. So just understand that you cannot do this. You cannot take advantage of this particular caveat if it is not some taxable investment account. That is a big key, because we know we also don't pay taxes on the gains that we realize within IRAs, 401ks, things like that, things like the tax advantaged accounts. But we do when it comes to the taxable investment accounts. So just beware the type of accounts that you have to know if you can take advantage of this deduction or not. Some people will be able to, a lot of people won't. But even if you won't, it's good to know this, because if you do end up having some type of taxable brokerage in the future, then you can go ahead and take advantage of this deduction if in fact it comes into play for you. Now, obviously, the reason that I'm bringing this up is that if you are to do this, if you are to harvest your tax losses, right, if you are to sell and realize a tax loss, it has to be done by December 31st. It has to be done before the new year, or else that tax deduction will not count on this year's taxable income. It will only count on next year's if you were to realize it in 2021.